evening, ladies and gentlemen. Thank you so much for joining us here for the 10th edition of the State Bank of India Conclave. We at CNBC TV 18 are particularly proud that we've been part of this effort and this endeavor for the past decade, and I personally have been doing the CEO panel for the past decade, so it's great to be back here. Before we talk about India of tomorrow, I would like to address the India of today, and there are many current issues to address before we look into the future and look into our crystal ball to see where India could possibly be positioned. So, Mr. Khara, as the host, I'm going to start with you. Let's talk about the banking sector, because as we just heard from Mr. Joshi, it's been a great year. Not just a great year, it's perhaps been the best year in a decade for India's banking sector. Very robust, very strong credit growth, and of course NPA is not a problem at this point in time. He asked you to think big and to think bold. What could that mean?
Well, as far as the banking sector is concerned, it goes in sync with the overall macro. And if at all macro looks so promising, it's very natural on the part of banks also to act and think big and bold. It's not only, I would say that we get the encouragement because the kind of resilience which we have demonstrated in the last 1 year, or rather all through the pandemic, that's a reflection of the very sound policies which have been practiced and promoted by the regulatory environment and also by the Government of India. Indian economy to a greater extent is insulated from the global threats. Almost about 85% of our GDP is domestic. And there is a huge demand, domestic demand is there, thanks to demography, thanks to the GDP growth which we are seeing. So demand is it's quite strong, and we don't have the supply side challenges. And that is something which we have seen in terms of the inflation, the way RBI has acted throughout the year. We have seen that we stopped increasing interest rate much before the global central banks stopped increasing the interest rate.
The question now is, when do we start to see the cuts coming in?
Sorry?
When do we start to see the cuts coming in?
I think we are on a right trajectory because inflation is much within control, but we are very clearly aiming for just about 4% inflation. But I expect that maybe somewhere middle of the next calendar year we should get to see the reduction in interest rates.
Since we are talking about interest rates, sir, you've hiked deposit rates just today, Mr. Khara, by up to 50 basis points across different tenures. Is it because Ashish Chauhan is giving you a run for your money? I mean, what's led to this deposit rate hike?
No, it was actually, we always believe that we have to stay, we have to offer a fair deal to our depositors also. We don't want to compromise the interest, and as far as deposit is concerned, it has got a franchise value. As we are more than 200 years old, we have to take care of our depositors too. So that is the reason why we have done some calibration in terms of interest rates.
So is this going to be the trend? Because you have clearly kick-started it. Do we anticipate this to be the big trend now through 2024?
I don't think so. It will be the decision which will be taken by a bank depending upon their individual positions. But yes, of course, we had some elbow room available, so that's the reason why we have done this.
Okay, I'll come back to the navigating of opportunities and challenges in just a second, but let me cut to today's opportunities and challenges as well. And Ashish, let's address the market movement. As an umpire, you cannot comment on the market movement, but what a great day it's turned out to be. Another record high as far as our markets are concerned. What does the story at the end of calendar year 2023 look like to you? The FPIs have returned, domestic participation has been very, very strong. What would you articulate that has been the big trigger, has been the big turning point as far as the equity story is concerned in this year, and more importantly, looking ahead?
Thanks. In a way, if you look back for the entire year, I think Nifty has returned almost 18%, still 2-3 days to go. There are other indexes which have returned 23, 40, and
Nifty Bank has done very well.
And
as well.
the small cap Nifty has returned 60%.
Yeah.
Right. So effectively, if you see why it has happened is also interesting. But if you look back previous year vis-a-vis this year, the interest rates were going up because inflation across the world had gone up because of the wars and supply chain disruptions and all. And that's where basically the year began. And somehow the FPIs were pulling the money out. And in some ways, few times I have said that this is the year where the circumstances did not take over Indian activities. Earlier, whenever the oil prices went up, we used to be in trouble. Interest rates abroad would go up, we would have FPIs taking money and markets will tank. This is the first time we didn't see that happening. Indian investor was sort of investing increasingly larger amount every month. And that's why the Nifty and every other index kept on staying there. And then towards the end of the year, when the US started decreasing interest rates, and of course, there is a potential that it might go further down. That's why all the FPIs are back. There was also a China factor where China is going to slow down, which it did, and what its impact would be on the rest of the world. But I think, as Mr. Khara said, we have been slightly insulated from the world. On the other side, like today, you would have also seen another interesting statistics of India's current account deficit coming down to almost 0.1%.
Yes.
Because why did this happen is because our services and remittances have now gone much more than our imports of oil, electronics and gold, which were like three things we could not have stopped. And once you start going up on the export chain, there is nothing stopping you. That's how I see this. Finally, we are reaching a place where we are actually preparing for a takeoff.
Preparing for a takeoff in 2024, and you believe that the groundwork has been laid. But, you know, since we're talking about, and I'll go into more details, but I want to talk about one significant inflection point that you expect or anticipate to see in 2024. The market is waiting for that. NSE IPO, are we likely to see that in 2024?
I don't know whether you've invited my regulator, but I wish.
Just to pick up on what Mr. Joshi said, he said that people sitting in this room, including people here on this panel, both representing the private sector as well as public sector, will be responsible to drive growth and will be responsible for the investment pickup. Now, given the power demand that you foresee today, as well as the visibility that you have on demand going forward, what should we expect in terms of capacity addition? What would that result in as far as CapEx spends are concerned, say, over the next 5 years?
Yeah, I think Dr. Joshi was very bang on, and he was very right that the corporate has to really follow. I think he is in the role of making policy and enabling environment, and we all have to really make sure that it is being implemented on the ground. As far as NTPC is concerned, we had been, our capex has been in the range of around 25,000 crore, kind of thing. Going forward, it is going to increase, and it is going to increase at least by 30–40%. And we have to reach, we have stated objective that by 2030 we will be adding on the renewable side 60 gigawatt. So today we are having 3.5 gigawatt which is commissioned, 7.5 gigawatt is under construction, so it's almost every month something capacity is getting commissioned, and another around 20 gigawatt which is in the different forms of the kind of developmental activity. So we have no doubt that we by 2030, we will be able to achieve 60 gigawatt rather before that. And we know that 1 megawatt is somewhere between 4 to 5 crores. So it's I think the math is very simple in that case, at least for the CNBC.
Yes, for CNBC and our viewers will do the calculation, but a 30 to 40% increase in capex is what you anticipate to be able to cater to the demand expectations. Mr. Acharya, let's talk about capacity and let's talk about demand as far as JSW Steel is concerned as well. You're going to be adding another 7 million tons, I believe, by FY25. Given where we find ourselves with the strength and the resilience that everybody is talking about, what's the kind of demand outlook you foresee? And more importantly, not just domestic demand, but also export demand. What's the outlook?
Yeah, so I think, India being the fastest economy, we are seeing a very strong growth momentum in India. And this will continue for, I think, about 2 decades. We call it the nation-building phase of the country. And during this time, structurally steel will be required. Usually steel demand accelerates at a faster pace during this, let's say, period, 1.5 to 2 times of the GDP. So in the last 2 years, if you look at the demand, the steel demand has grown by 13% the previous year, and this year it's growing at close to 15%. If India wants to be self-reliant in terms of steel, we need to add capacities just to make sure that we don't import steel. We therefore at JSW Steel are building capacities. Currently our capacity is about 28 million tons in India and 30 million tons globally. We plan to take our capacities up to about 50 million tons before the end of this decade. We see a strong momentum, maybe not 15%, but a 10% double-digit, 8 to 10% growth is something which is easily possible. And this would call for a capex, additional capex in excess of 100,000 crores.
Of 100,000 crores. What do you believe is driving this demand at this point in time? And especially as far as the export market is concerned, with China being, since that's a big factor that everyone has spoken of on this panel as well, with China being in the phase that it is going through at this point in time with an uncertain recovery underway, what is the opportunity that presents for Indian steelmakers like yourself and for India?
So I think India is lucky to be, as Mr. Khara rightly said, we are lucky to be a domestic dependent economy. So we see also about, I think typically 10 to 15% is the exports from India if you look at direct steel. But where the opportunity lies, I think India is going to, first of all, as a country, let's put it this way, that India's current capacity is about 170 million tons as we speak today. Our aim is to get to 300 million tons of capacity, and the production would be in the range of 250 million. Which is double of what it is today. Majority of this would be consumed in the domestic market. As we grow into the, I would say in the next 7 years, as you said, I would see more exports of engineering goods out of India and less export of direct steel. So if I were to see the ratio between India and China, we export about 1/10 engineering goods versus China. Now with this opportunity opening up, post the China +1, kind of a preference, I think India has a huge opportunity to grow this pie.
Bhoumik, let me address the issue with you as well in terms of trend spotting now. Given the momentum that we're already riding on, what would you say that we need to focus on? And more importantly, what will you be watching out for? What are those headline numbers that you're going to be watching out for?
I think a few things that we've been seeing for the last couple of years. We've all been amazed at the resilience that Indian corporates has shown through this significant headwinds that have been faced. And even as we were seeing significant upgrades to the ratings and people were a bit skeptical about that, I think a lot of that has actually borne out. I think what we continue to watch is the way Indian corporates are taking advantage of the opportunities. Mr. Acharya talked about engineering opportunities, and we're actually seeing that in capital goods as Indian entities have, I think, order backlogs up to the next 4 years, supplying transformers and other equipments for renewable capacities in the US. There are opportunities on the consumer side, not the staple part, but on the aspirational products where people want to upgrade themselves. Infrastructure, of course, would continue. Cement, steel, power, of course, is seeing a major transformation. I think this is indeed a good time. From a rating agency perspective, I suppose one of the things we would see from a policy, and we have very alert regulators, one of the things we would continue to like to see is balance sheets continue to be buffered up. Through counter-cyclical strength, so that whenever a downturn comes, or if an idiosyncratic event were to hit, either through cyber frauds or governance issues, entities are better prepared. So we would like to see those buffers being even more strengthened.
You said that this is indeed a good time for India. Let me go back to very recently, I think just about 2 days or 3 days ago, the chief economic advisor has basically said that rating agencies don't seem to acknowledge the fact that India has done actually very well and should in fact be changing their stance and their position on India. How do you react and respond to that?
I don't have a sort of a ringside position on that because I don't sit in on the rating committees. I'm sure rating agencies are listening to this long and hard. And I think the criteria that they adopt is transparent and is well explained. But I think the bigger point is, if you look at the articulation that rating agencies are making at this point, I think it's become a lot more balanced, a lot more benign now. People understand the benefits that growth is bringing in. And all they want to see is that it's a narrow, limited point of the balance sheet of the government, whether that is going to adhere to a declared path, and whether that path is going to be sustained and confirmed.
Mr. Khara, let's talk about the road ahead. Now, there is a meeting with the Finance Minister on the 30th of December. I would imagine that that's stock taking about the year gone by as well as what the year ahead looks like. But outside of the next few months, what needs to be prioritized now from a banking sector's perspective? The unfinished reform agenda, for instance, on the insolvency code, there are amendments that have been sought, amendments that have been spoken about, discussed. You know, what should the road ahead look like now in terms of priorities from your perspective?
Well, I think, one, of course, we have to support the growth initiative, and we are very clearly, there's a lot being talked about the private sector investment. So, if I may say, from this forum, we have got a very clear visibility in terms of the fresh proposals coming in. What we have actually seen is that the private corporates, they had a lot of cash sitting in their balance sheet. First and foremost, the investment happened by deploying that cash. And now they have come to a stage where they have understood the growth opportunity which is there, and we are very much there to support their such initiatives so that the private capex should now take off. This is what our first priority is. And of course...
but we've been waiting for that takeoff. I mean, it's been, in the words of the Chief Economic Advisor, incipient signs of private capex picking up. When do we start to see robust signs of private capex?
In fact, that is what I'm saying, that, you know, until now, we have seen that the investment has happened from the internal resources. As Mr. Gurdeep Singh also said that there is a huge capex lined up for the next financial year. And similarly, I would say that many other public sector entities have also lined up the capex for the next financial year. The way I look at it is that it is going to be a blend of both the public sector, government, and also the private sector, but we will get to see more private sector investment also coming from the banking system as well. So that is one priority. And second, of course, digital is something which has been one of the very forefront for all of us. And we have invested well in terms of upscaling ourselves as far as the digital capabilities are concerned. And of course, all said and done, the cyber is one area, cyber risk is one area which all of us need to really guard against, be it banking or non-banking entity, any entity, because today there is a huge dependence when it comes to the operations of any entity on the information system. So we have to guard against that. That is another very important priority for us. And I think the other area where we all need to work on is how to make the organization digital-driven organization in terms of leveraging analytics. So that is one of the other very core focus area for us, to understand the customer better and offer them the products which they are all looking for.
So if I can just focus on that, because that's the running theme as far as this panel is concerned, that a lot of the growth will be driven by technology and also the technology transformation that banks like yours and other companies will have to undergo. You know, how much are you investing in technology today, for instance? What do you foresee that to become over the next 5 years? What will that mean in terms of bank branch expansion? What will it mean in terms of workforce allocation, reallocation? You know, lay out for me what you envisage the next 5 years to mean and what technology will do for you.
Thanks to digital, today we are bank of our size, we have got almost about 88% of our transactions are digital. And 98% of the transactions are happening outside the branch. But if somebody asks me whether we don't need so many 22,400 branches, my answer is no. Because the kind of diversity of customer base whom we serve, we have to have the physical presence. And let me share with you, when it comes to financial sector, unless and until there is a physical location of an office in the far-flung area, the ability of a brand to get the confidence of the customer is rather very difficult. So I think from that point of view, after all, since we deal in a fiduciary capacity, we deal with the customer's money, our presence on ground makes a whole lot of difference. And also, having said that, I must also mention that the country needs a lot to invest in terms of financial literacy. And from that point of view, the public sector banks have done a great job all this while. But if you ask me whether we have completed that, I think still there's a room for improving that financial literacy. So I think to that extent, we will have a coexistence of digital as well as physical. So that's why phygital is going to be a reality for us, for all the banking system. Having said that, I must also mention that when it comes to what you mentioned, what will really engage us for the next 5 years, to my mind, there are many repetitive jobs which are being done at a bank. So I think the Gen AI is going to be the next big talk. We have started.
Next big talk or next big thing for the bank? Have you already started to incorporate?
We have already started working on it. So that is something. We actually started working with the analytics in a big way. And now we are moving towards the Gen AI. So I think in the next 5 years, we'll probably see that unfolding. And probably it will help us in addressing the customer's need. And also will probably shape up the way banks will be run in the days to come. So many of the repetitive jobs we will have, probably will get to see the distributed ledger very much in adoption going forward. We'll get to see Gen AI getting implemented in the banking system, and we will get to see the data-driven organization as far as the banks are concerned. So which will actually show up in terms of our ability to manage risk, ability to understand risk, ability to understand the customer's behavior, and also figure out the exceptions in no time. So which will also address part of the risk which are there in the digital.
Let's talk about the manufacturing story, because as I pointed out that you are a beneficiary of the PLI and you hope to start building that out. Over the next 5 years, what is the kind of potential that you hope to unleash here from India as far as the export market is concerned? You've got collaborations with HP and, with Google and others, and you are manufacturing for them here as well. What do you foresee that to result into over the next 5 years?
I think one of the disruption which PLI is going to be bringing is on the semiconductor industry. While we all understand, and semiconductor is the backbone of any technology and IT adoption, starting from your IoT devices to handheld devices or to any largest data center. And that was the one place where probably India has not done well. While on technology adoption, India was always ahead. Software technology development, we were all ahead. But semiconductor is something which we are behind. And if this PLI goes the way government is trying to drive in next couple of years, India is going to be the strongest base for the semiconductor technology, starting from R&D to development to manufacturing of those things. And most of the tech company are taking the advantage. And this is one of the reasons why I was saying that this quarter, India has become #1 in terms of the manpower deployment globally, because we have moved a large number of resources in the core tech side on the core development and R&D from the various parts of the globe to India. And we are seeing the same trend happening in the semiconductor industry and technology side. And over a period of time, we feel that this is going to really fuel the growth for next 10 years, the way we are saying. And as per the word estimate, and IMF has already made the estimation by 2026-27, India is going to be the third largest economy, global economy. And we feel that this PLI scheme, specifically in the tech side and in the semiconductor, is going to be fueling that growth.